So, guys, the key question that most traders do not ask, and yet it is one of the most important questions out there, is understanding where is the opportunity at this moment? Is it even in the asset that you're trading altogether? So, I'm going to give you an example. I'm pretty zoomed out here on the daily time frame. If we go all the way to the left, we've got from basically 2008 until current time right now. Each one of these periods is different. And so going into trading, thinking, look, I've got one strategy and I'm just going to trade it on one market in the exact same way at all points in time forever is a failing idea. Why? Because look at how differently things move. And let's actually break down what those differences are. So, for example, in recent times on Euro USD here, we've been in a quite wide range choppy environment. Now, if we were to go back to somewhere like this, we can see we are also in a choppy environment, but it is a more volatile one, meaning we have bigger strides up and down on average within that sideways movement. And you can see an example of that is if we overlay one on top of the other, you can see that it's almost twice the size just by eyeballing it. Now, if we look at a different period, we will see that during something like this, we have a very aggressive trend to the upside. Now, we also have a trend to the downside here, but it is a much smaller one. If we were to continue looking at some extreme examples, we can see a very, very aggressive move right here. We can see a very, well, pretty aggressive move right here. You could argue even down to here. Versus we have some choppy behavior, but still an upwards trajectory movement over here. This would probably be better suited to something like this. One of the big mistakes that I make back in the day, and this is something that I think so many people make, and I still see so many people making it, is they come into trading and they think that it's strategy equals money. Now, this actually is true. The only problem is you're missing out a few steps here because what most people think of as a strategy is okay, if I do X, Y, Z, then and I just do it over time, then it has to make me money. It's a little bit more nuanced to that because as you can see, there are different periods in the market. Now, how does what you do as a trader differ from, let's just say, an institutional investor? Now, I've had the privilege of meeting a lot of institutional traders over the years. And so I have had insights into how some of them trade, and a lot of them trade in different ways. But one of the key things that stands out amongst them all is their choice of environment. And another word for this would be their choice of opportunity. They're not always just they're not always just looking at things day to day. They're not always just going, okay, look, this is the pair that I trade. This is how I do it. This is what I'm going to go for. Some people do, and that's also fine. But I'm going to show you the other side of the coin so that hopefully you can come to your own decision and conclusion. And then I'll show you exactly how I work through it as well. But the choice of environment and opportunity, because somebody who is actively looking for the right environment and opportunity and actually makes that a key part of the system is going to have some very, very distinct advantages. For example, during periods like this, being able to identify something like this versus being able to identify something like this is going to give you a distinct advantage. An easy example is if we go to the Turkish lira. So if we just put in, let's just go to Forex here quickly. Sorry. So let's just do, okay, so pop this here. So we have the Turkish lira against the Japanese yen. We just zoom out here and just look at how prices have moved. This has been probably the most extreme example of growth that you will see in an FX market. I'm going to have to go to the weekly just to get it all on screen. You can see that from down here in 2008, we've gone up by a ridiculous amount. Absolutely ridiculous. Now, this is going to be a lot rarer. But the reasons for this is because if somebody had been actually looking at, okay, where is the opportunity, and they were someone who liked to, let's just say, ride trends, then just taking the extra step and incorporating a environment picking or an opportunity picking element to their strategy would have meant that instead of them stressing about, okay, is it this pair, is it this pair, is it this asset even, am I trading the right asset at all? They have primed themselves to themselves to capitalize on something that is very, very specific and underlying. Now, the unfortunate truth and the sad thing, I suppose, if you could call it sad, um, is that this is not something that can just be done with technicals. And there's a reason for that. And it is very, very simple. Technicals equal past. I don't care if you're trading smart money, whether you're trading something really basic like support and resistance. The idea of technical analysis is we are looking at the past and we are all working on the premise of one statement, which is patterns of the past are likely to repeat in the future. You will notice if you go to many brokers, you will see on the bottom of their websites, they will throw out statements like past performance is not indicative of future results. Why is that so important? Because they're not just saying that for their health. This is a very regulated space, in investing. I mean, that the FX markets isn't regulated, but where people put their money is very, very regulated. And so this is really important. They're not just putting it up there just for the sake of it. They have to put it up there because it's true. The patterns of the past can be likely to repeat themselves in the future, but not always. And so if I had it my way, I would want to position myself in the best way possible, where I'm tackling things from two perspectives, where I have the patterns of the past and I have some prediction of the future. Because as much as we may like to kid ourselves, technicals on their own, whilst incredibly, useful to some extent, they are not predictive in power. They are mostly useful as a way to frame risk management and a way to basically just manage risk and gain a very, very, very small edge, if possible. What makes it additionally helpful, the extra layer, is what we add to this stage, the strategy stage. And really, that comes down to how do I identify an opportunity? So I'll give you an example. One of the strategies, in fact, the main strategy that we talk about in our community, at least for now, we will be adding another one soon, is mean reversion. So, what is this as a strategy? Well, this is the idea that, if price has been moving in one direction for an extended period, then at some point it's going to have to snap back like a rubber band that has to snap back to some degree. Everything else and the specifics around it and the settings, those are the kind of fine-tuned details. But at the core, it's literally just saying, look, if prices are moving like this, then they're likely to snap back. Now, why is it so important to understand the environment? Because let's ask a question. Do you think that a mean reversion system where we're basically fading moves that go up in extremes is going to work better in an environment like this, in between these orange lines here? Or do you think it's going to work best in an environment where we have this accelerated move in one direction up here? Well, obviously, it is going to be this first environment right here because we are in a choppy environment. Now, therefore, if somebody has not taken the time to understand or to put any thought into being able to maybe predict that this environment was coming, then what's going to happen is a trader who may have performed incredibly well during these periods, maybe they make a YouTube channel, maybe they write a book, or maybe they go on news websites or whatever, and they start talking about how amazing their system is. What they will then leave out is that when they get to this sort of a period and they haven't prepared for it, what's going to happen is they're going to basically give away all of their profits, maybe even more, or maybe just get back to break even. Whatever the situation is, it's not going to be pretty. And this is what will happen. People will cycle around. They'll lose faith, they'll lose motivation. Maybe they'll make some money back here, then they'll lose it all again here. Then they'll make some of it back here, then they'll lose it all again here. And what they will do over time is they'll start thinking, look, I am going through these ups and downs, but eventually it's going to reach a point where I'm just on an up and up, where I'm just going on that up cycle and I just finally become a profitable trader. And the unfortunate truth is that you may never reach that point if you don't understand how to pick the right opportunity. How do you identify what is a good environment to trade in? Now, one of the things that we do to mitigate this is we have a selection process, which does use some fundamentals, which is basically broken down into two main segments. Okay, now the first one is going to be the easiest to predict of the two, which is volatility. And I'll explain that in a little bit more detail in a minute. Next one is going to be direction. This is going to be a lot harder. It's especially hard to do in the FX market because there are a lot of variables that come into play. So this is why, for the most part, we like to stick to this because it is a lot simpler to do than this. And I'll explain why for each of these. So let's just break them down. So volatility, what is volatility? Well, at the simplest level, it's basically price movement. So for example, if we have a tight consolidation like this is going to be typically a period of low volatility. Now, we might have a higher volatility period of consolidation as well, where it kind of is a bigger range, but this is still going to be lower volatility than an environment where we just go down like this. This is going to be high volatility. This is going to be very low volatility. And this is going to be kind of low to medium volatility, right? Now, volatility itself, the reason that it is so powerful in forecasting is because you don't technically need to understand the direction. For example, if I go back to this environment over here, in fact, let me just get rid of some of this because I know it looks really messy right now. Just get rid of some of these. So if we just highlight these two areas here, these two gray boxes are both areas of high volatility. Regardless of whether you knew the direction, if you could just forecast the volatility, which is a lot easier, and let's just say you only had a mean reversion system, maybe you have a trending system as well, that's fine. But let's just say you only had a mean reversion system, meaning you were trying to kind of basically fade extremes. It's very possible that you could, sell, lose, sell, lose, sell, lose, sell, lose, sell, lose, sell, maybe win, sell, 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 sell. It's very easy to just lose, 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 and give everything back. But even if you didn't know the direction, even if you knew, okay, look, we're going into a period now where I'm thinking that volatility is really likely to increase and increase by quite a significant amount, that's going to massively affect how we interpret the market. Maybe it means that we wait for a bigger extreme, meaning instead of us seeing maybe this initial move here as an extreme, and we just zoom in for you, seeing this as an extreme, maybe we wait until a lot more of a clearer level. Now, we're not particularly keen on levels. There's nothing wrong with levels, but just the system that we use doesn't really use levels anymore. But let's just say we were looking at this. This could be the difference between chopping off 3, 4, 5, maybe even more losses. And these things add up over time. So, for example, instead of us getting involved here for the first one, we could say, look, I'm pretty confident that we're about to go into a high volatility period. And so I'm not going to take that first position against the trend until we get to around about this level right here. Okay. Now, whether that ended up in a take profit or a stop loss, it doesn't actually matter because we're thinking in terms of being risk averse. Maybe again, the next level we were looking at was kind of somewhere in this upper region up here. Maybe that still didn't work. Maybe we're like, okay, look, we're still going to go into higher areas. Maybe we're going into this area. Why is this approach different? Does it mean that we are escaping all losses all the time forever and it's all really rosy and lovely? No. But what it means is it's the difference between saying, look, I was originally going to get in, let's just say I was going to sell, then maybe sell again, then sell again, then sell again, and sell again, then sell again, then sell again, then sell again, then sell again, sell, 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 sell. So how many is that? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. Let's just say all of those were losses. That's minus 14R. Okay, if you're risking 1%, that's obviously going to be minus 14%. That is going to be a tough pill to swallow. Now, even if we had done nothing else, we knew nothing about the direction, but we had just implemented that thing that I spoke about before, where we were being a little bit more strategic about where we were getting involved because we were expecting higher volatility. It's the difference between minus 14 and maybe let's just say we lost this, we entered again here, we lost, we entered again here, maybe we won. It's the difference between minus 14 and then only losing 2 and then maybe having a winner as well, maybe another plus of 1.5 or 1 to, or maybe plus 2, depending on how things go. But typically our results for each trade will be 1.5, so 1 to 1.5R or 1 to 2. So basically it's the difference between having a big series of losses and a small series of losses. And it came without understanding direction whatsoever. Now, how do we do this? How can we go ahead and understand this? Well, the bad news for a lot of people is that it does involve understanding just a little bit about fundamentals. Now, the good news is it doesn't mean you have to be an expert. You don't have to understand the complex interrelationships of all of the things that make up the economy. It just means you need to understand what the key things are. And the big thing above all, and this is kind of the big key that I'll give you for now, and I'm more than happy to make a follow-up video going over some more details. Then obviously, if you'd like a more comprehensive comprehensive approach and kind of way we can ask questions back and forth, then feel free to join the Discord. But from a volatility perspective, this really comes down to understanding what the big fear is. Okay. The big fear and its impact on interest rates. Because really, these are going to be the big two things that come into play, especially when we're dealing with currencies and anything that is also related to interest rates. So maybe you're a bond market trader where you're buying treasury notes or anything like that. But really, the big fear. So for the last few years, for example, the big fear has been inflation. Because of everything that happened with COVID, we didn't really know. There was a lot of uncertainty as to like, oh my God, what are the rates going to be and all this sort of stuff. Now, even if you knew nothing about any of that, who decides the interest rate? Well, the interest rates are decided by the central banks, right? So just by understanding when the central bank announcements are and just avoiding those particular days and understanding how often before and after those speeches can volatility increase, that can be a big thing. The next thing is you can look for when multiple of these things cluster together. You can look for patterns in how often the data is pointing towards a specific outcome. For example, if you're looking at the economic health, which is very, very basic to do, you look at some basic stats, just make sure that, the employment's pretty strong, the inflation isn't ridiculously high, and the GDP is kind of growing or at least stable. As long as those things are all okay, and you're monitoring what the central banks are doing, you can gain a pretty good understanding of, look, are we in a period where the big fear is going to cause massive uncertainty? Because you've got to remember, right, that the markets are just tools for obviously multiple things, but they're heavily influenced by investors of all types. And people want to make money. They don't want to lose money. And they either want to protect it or they want to make money. And therefore, in simple language, right, if there is something that is perceived as high risk or uncertain, that is going to cause money to flow out of whatever is perceived as risky. So, for example, if the euro is suddenly seen as really, really risky, then money is going to move out of the euro. And if more money is moving out of the euro than is moving into the US dollar, then euro USD is going to drop. Okay. And it's really, really as simple as that. Now, of course, this is a very simplistic way of looking at it, but this is a very basic way of doing it. Now, the next step above that would be to say, look, I'm not just anticipating a volatility increase, but I am convinced more so that prices are going to travel more in one direction than another. These setups are going to be harder to find in the FX markets. Now, there is a reason for this, because if we zoom out, the purpose of most of the FX markets, well, the purpose of FX markets in general, is price stability. It's not trends. This is why if we go to something like a monthly chart, you'll see that over the past, yes, we've had big periods of trends, but all in all, we do have general price stability. We've rested around the same sort of cluster of an area. The point I'm trying to make is if you go to something like the S&P 500, which is what I was trying to do there, over the long run, it goes up. Yes, it has periods of down, but overall it's going up. Why? Because the purpose of that is it's an amalgamation of various companies in the US. And you would expect, because a company's goal is growth, that that is going to grow over time. Whereas the FX markets, we are trying to keep the prices fairly stable. This is why, when it comes to direction, most trend-based traders, in my opinion and my experience, tend to do best outside of the FX markets. And understanding how to understand direction, first of all, comes into understanding volatility, but then it comes into a few other things as well, which is expectations and understanding the dynamics that move that market. Now, here's the thing, and this is the little extra bit that I will give you just to kind of maybe go away and have a think on. When you're trying to understand direction of a market fundamentally, what you want to do is you want to pick a market that has the least variables possible that can influence the direction, because it makes your job easier. For example, if you're trying to predict the direction of the FX markets, realistically, that is going to be more difficult than predicting a much simpler market with a lot less variables, a lot fewer things going on for it. And the reason for that is because with FX, you've got speculators, you've got so many basically international factors that come into it, from politics to, to central banks and their interactions with one another and sentiment and all these sorts of things. Now, it doesn't mean that direction is useless in FX. It just means that in order to capitalize in FX like we do, We focus more on volatility, and we focus more on having strict risk management profiles and structures that allow us to profit even regardless of having a clear directional bias, because we know that most of the time the market is the FX markets are not massively trending environments. And we've built everything around that. But really, the first step is about understanding the opportunity. Where is the opportunity? If you were a trend trader, where might that be? If you could have gone back in time and looked at the Turkish lira against the Japanese yen, okay, and seen, okay, what was it that has happened over this period that has caused such a ridiculous meteoric rise that is almost unheard of in FX? You know, in the last decade, you would have had a perfectly trending environment, which, if you're a trend trader, is a great, great, great environment for you to begin to operate in. And so this is the skill that I think is really underestimated and under talked about in the space. We have systematic rules that we like to use because the strategy itself is actually quite easy to implement. But the thing that makes it powerful is understanding, look, is this the right environment for us to capitalize on what this system is built for? Because every system is not going to work perfectly in every environment. And most people just hope that they're going to land in the perfect environment and hope that it's all going to be nice and doodle dandy. That is the wrong approach, in our personal opinion. And so, yeah, so I hope that this has kind of shed a little bit of light for you guys. I'd appreciate you leaving a like. And if you've got any questions, please leave them in the comment section below. If you'd like to see a follow-up video going into more depth on any of these things, please be specific about what you'd like to see below, and I'll make that for you. I'll also leave a video that I think you'll find really helpful to watch up on the screen now. And of course, if you'd like to learn anything more about any of these things, or just have a general question, then feel free to shoot me an email. I'll leave the email that we use here at Psych in the description box below. I hope you have an amazing rest of your day, and I'll see you in the next one, guys. Take care.